The market is sitting at all-time highs, but the internals are screaming caution. This is a classic price versus reality disconnect. Here's the plan for the next 1 to 2 weeks.
Okay, so this is the core conflict we're dealing with right now. You've got the S&P 500 making new highs, looking totally euphoric. But then you look under the hood, and the fear and greed index is flashing extreme fear. This kind of divergence is exactly where opportunity and a whole lot of risk lives. We need to figure out what gives first.
All right, here's how we're going to break this down. First, we'll dig right into that core conflict. Then, the bull case. Why is this market so strong? After that, the bear case, all the hidden fragility. From there, we'll talk strategy and wrap up with the key levels you need to be watching. Let's get to it.
All right, Section 1, the market's core conflict. Let's really unpack this divergence between the indices and what's actually happening with their internal health.
So look at this split. It is pretty wild. You have the S&P at an all-time high, that's your bullish price action, but the fear and greed index shows extreme fear. Meanwhile, the AAII survey shows retail traders are massively bullish, the second highest reading we've seen. And the pros? Active managers are leveraged long with the highest exposure since July. So you've got this underlying institutional fear, but retail and active managers are all in. That is a very tense setup.
Now let's flip to the bull case. There are some powerful reasons this rally is continuing, and it really centers on two things: earnings and seasonality.
85%. That's the earnings beat rate for the S&P 500 this season. You just can't argue with that number. It's the absolute bedrock of the bull case. No matter what other indicators are flashing, strong corporate profits are giving people a very real reason to stay long.
And it's not just the earnings. The bulls have a lot more going for them. We're heading into the strongest seasonal period of the year, November and December. The Atlanta Fed's GDP Now forecast is clocking in near 4% growth, which is huge. The tech giants, your Amazons and Googles, absolutely crush their quarters. And to top it all off, you've got Fed Governor Waller out there hinting at a dovish pivot. These are some serious risk-on tailwinds.
All right, but now for the other side of the trade, the bear case. This is all about the fragility, the structural decay that's hiding just beneath the surface of these all-time highs.
And this right here is the heart of the problem. Market breadth is just gone. The S&P 500 is up 22% year to date, but you take out just the top 5 stocks, it's only up 4%. The NASDAQ 100 is even more extreme. This isn't a broad, healthy rally. It's a handful of megacaps dragging the entire market up. That is an incredibly fragile structure.
And to add another layer of risk, the market's cozy assumption of a dovish Fed just got a reality check. Just last week, the odds of a December rate cut were pushing 90%. Now, after some recent Fed commentary, it's down to 65%. That's a significant repricing, and it injects a whole lot of uncertainty back into the monetary policy outlook.
Yeah, the red flags are really starting to stack up. The leading economic index, the LEI, just went negative, historically a pretty reliable recession signal. We've had 2 Hindenburg omen triggers, a rare technical indicator that flags potential for a market crash. The dollar is getting stronger, creating a headwind for earnings. And then you have the Buffett indicator sitting at levels higher than the dot-com bubble peak. Valuations are stretched dangerously thin.
Okay, before we get into strategy, here is the mandatory disclaimer. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
So how do you trade this? Let's move on to strategic posturing and build a framework for actually managing risk in this kind of conflicting environment.
A plan for each scenario is absolutely crucial. The base case is for choppy, range-bound trading, as seasonality fights it out with weak breadth. That's invalidated if the SPY can't hold its 20-day moving average. The bull case is fueled by earnings and a dovish Fed, and it's confirmed by a decisive break over 7,000. The bear case gets real if breadth totally collapses and the VIX breaks and holds above 18.
Let's just put it all side by side. The bull thesis is simple: earnings, seasonality, the Fed. It's a powerful combination. The bear thesis is just as clear. This market is a fragile, top-heavy structure built on a weakening economic foundation. One of these two narratives is going to have to give.
Given the sheer number of warning signals, a defensive posture just makes sense. So the first potential strategy is focused on hedging that downside risk using the VIX.
A VIX called debit spread is a defined risk way to buy some portfolio insurance.
The rationale is simple. You're exploiting low volatility with the VIX sitting near a support level to hedge against a market sell-off. Your risk is capped at the premium you pay, and the thesis is clearly invalidated if the VIX just can't break that critical 18 level.
But at the same time, we don't want to completely fight the market's strongest trend. So a second potential strategy is to focus on that relative strength in the semiconductor sector.
An SMH call debit spread can offer you some bullish exposure to the clear market leader, again with defined risk. The invalidation point is a clean break of its 20-day moving average. However, and this is important, given the broad market fragility we've been talking about, position sizing here should probably be smaller than usual.
All right, let's finish up with the most actionable part of this whole thing, the key levels that are going to act as our triggers for the week ahead.
Here is your cheat sheet. For the SPY, 7,000 is that key resistance. For the QQQ, $613 is the critical support level to watch. The VIX has to stay below 18 for bulls to remain in control. Keep an eye on the DXY for a potential breakout, and watch the IWM. It absolutely must hold support if we're going to see any improvement in market breadth.
And that really leaves us with the final question. You have a market that is pricing in perfection, celebrating strong earnings while completely ignoring obvious structural decay. The price is telling one story and reality is telling another. At what point do those two things finally converge? And finally, this is not trading advice, just a market update to keep you informed. Markets carry risk, trade your plan, manage your downside, and always verify all data.